In today's video, we're going to be exploring the balance sheet, and that's going to put us back in touch with our dear old friend, the old accounting equation, A equals L plus E. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that is my sidekick, Terrence, who is always in balance, just like our balance sheet. And we are here to put the fun in accounting fundamentals. So we're going to jump right into a spreadsheet today, and we're going to take our balance sheet from very basic to more complicated so that you can take your knowledge of the balance sheet and you can apply it to any business and understand what's going on with that business. So we're going to start out with a very basic balance sheet, and the balance sheet mirrors the accounting equation. Assets equal liabilities plus equity. And of course, I'll link the accounting equation video in the description so that you can check that out if you haven't seen it yet. So on the top part of our spreadsheet, we have a very basic balance sheet. We have our assets, we have our liabilities, and we have our owner's equity. So those are the three sections of every balance sheet. We add on details, but this is the fundamental balance sheet right here. We're looking at our assets, our liabilities, and our owner's equity. Now, depending on what type of business this is, whether it's a sole proprietorship or it's a corporation, that owner's equity piece may be called different things. So it could be called stockholders' equity, or it could be called members' equity if it's an LLC. It could be called partners' equity if it's a partnership. But for the purposes of this video, starting out, we're going to call it owner's equity, keep it simple. Now, if we look down below that, you can see the beginnings of what a balance sheet looks like. So we're going to have assets on one side and then liabilities and equity on the other side, just like we do in the accounting equation. But this format could also be a top to bottom format where we have our assets in one section and then below that, a section for liabilities and equity. It's the same thing, just a little bit of a different format. So in this case, we're looking at a cash basis balance sheet to start, because there are some differences between cash basis and accrual basis balance sheets. So I put together a little example here. I'm saying that we have assets of $100. We have liabilities of $40. The difference between the two is $60, which is our owner's equity. You'll see that both sides always have to be in balance, which is what we've talked about always with the accounting equation, always has to be in balance. And under the cash basis method for accounting, we count revenue when it's received and we count expenses when the cash is dispersed. So that's different from accrual. So when we're talking about the balance sheet for cash basis, there are some things that don't happen. So let's take a look at a little bit of detail for our cash basis situation here. So let's say that we want to add on some accounts here. We're not just going to lump everything into assets or liabilities. We're going to spell out which accounts we're talking about. So in this case, we're going to say we've got an account called cash and an account called inventory. And those two amounts, the 60 for cash and the 40 for inventory, give us our total assets. And on the liability side, you'll see that there's nothing there. Well, why would that be? Don't you have accounts payable? Well, under cash basis, we don't really have accounts receivable, accounts payable, because we only count those things when we actually receive the cash or disperse the cash. So under true cash basis accounting, you would not have those accounts. But you can use something called modified cash basis, where you would include accounts receivable and accounts payable. And this would be for smaller businesses that are on a cash basis. Let's switch over now to accrual basis accounting and our accrual basis balance sheet. So under our accrual basis balance sheet, we are going to have things like accounts payable, notes payable, accounts receivable. And you'll see that reflected here. So we've got cash, we've got accounts receivable, inventory, and now we've got a vehicle as well. So our total assets are now $160. On the other side of the equation, we have our liabilities and equity. In this case, we're saying we have accounts payable and notes payable that give us a total liability of $60. And the difference between the two, your total assets minus your liabilities, gives us that owner's equity amount. Well, now let's look at a merchandise business. And really that's what we were talking about in our last example, because there was inventory. So for a merchandising business like Walmart or Amazon, we're going to have inventory. And if we're selling on account to our customers, we're going to have accounts receivable. On the liability side, we're going to buy things from our vendors. We're going to pay them later. We're going to have an accounts payable. If we have a note payable, for example, on our vehicle, that's going to turn up here as well. So those things don't really change for this merchandising business. And the biggest difference is that inventory amount. Now, if we're talking about a manufacturing business has one more piece to this. So we're going to take our inventory and we're going to break that out by raw materials inventory, work in process or work in progress inventory, and finished goods inventory. And those finished goods inventory, that's what we have available to sell to our customers. But until it sells, we're going to keep it here on the balance sheet and not move it until it actually sells, when we'll move it to our cost of goods sold. So everything else has stayed the same for a manufacturing business. We've just added on those additional inventory accounts so that we can keep track of things as it moves through our factory. Now, in our previous examples, what we've done is we've kind of lumped things together, assets, liabilities, equity. But now what we want to do is something called a classified balance sheet, where we're going to add some categories to this. And we do the same thing on the income statement side. We start to add some classifications, some categories, and it helps us with doing financial ratios and to just really get a quick glimpse of what's going on with a business. So in this case, we've added a line for current assets and fixed assets, also known as long-term assets or property, plant, and equipment assets. On the liability side, we've added a section for current liabilities and a section for long-term liabilities. And then our owner's equity, we've broken that out into some additional accounts. So what we're doing here is we're just trying to get a clearer picture of what's going on in our business. So when we separate out current assets, we know that we have things that are liquid or close to liquid, meaning they're either cash or they can be turned into cash quickly. And that gives us a certain picture of the business. Is the business ready to pay its bills? Is it able to meet its obligations? And then we separate out our fixed assets because we need some more detail there. We need to have an accumulated depreciation account that goes with each of our assets or each group of our assets. So we start to build out a better picture of this business. On the liability side, by separating out our current liabilities, we can look at that very quickly and say, okay, let's look at our current assets compared to our current liabilities. Do we have enough liquid cash to cover our current liabilities? Can we pay our accounts payable? And we can look at this very quickly and say we've got $110 in current assets and we have $40 in current liabilities. So yes, we should be able to cover our accounts payable. Very helpful to know that ahead of time. We can also look at our long-term liabilities and make some determinations as to how much money we're going to need to make those payments as well. And then on the equity side, we've started to separate things out. We've got now an owner that we are assigning this equity. This is a one-owner business. So we've got Joe Smith equity or capital with $110. And then we've got Joe Smith withdrawals. This is money that he has taken back out of the business for $20. So he now has total equity of $90. We add that to our total liabilities of $60. Gives us $150. So you can see as we start to classify things, break things out, that it opens up the door for doing some really great financial ratios, financial analysis, and it becomes a much better tool for running our business. Now, as an accountant, when I walk into a new business and I'm looking at their financial statements, one of the first things I'm going to look at is I'm going to look at their accounts receivable versus their accounts payable. So what do our customers owe us and what do we owe to our vendors? So in this case, we have $10 in accounts receivable and we have $40 in accounts payable. To me, that would be a point of concern. Like we don't have enough in accounts receivable coming in order to pay our accounts payable, which means we have to rely on our cash. So the theory is that your customers would be paying you about the same time that you need to pay your vendors. Well, if you don't have the money in accounts receivable, or you have customers that aren't paying on time, then you're going to end up having to pull your accounts payable from your cash. So now you've got less cash, You may have a problem making payroll. So you can see where it starts to give you some interesting information about a business. But if we're just looking at this current balance sheet, it doesn't give us any kind of background or any kind of comparison in order to say, are we better off or worse off than we were a year ago? So that's where comparative balance sheets come in. So in this example of comparative balance sheets, what I've done is I've taken our previous classified balance sheet and I've just plunked it over here and called it current year. So the current year picture is what we just looked at. We've got $60 in cash, $10 accounts receivable, $40 accounts payable. If we just looked at that, we have no idea how this business is doing other than, it's okay, I guess, but we don't really know. But if we add to it last year's balance sheet at the same time, we get a very different picture of this business. So a year ago at this time, let's say we had cash of $1,200 compared to our current cash of $60. That's a huge change. So if I'm an accountant or someone looking to invest in a business and I look at that number, I'm like, what's going on there? We also see that our accounts receivable was a lot higher. Those are really the only two things besides equity that I've changed in this picture. But you can see that just those two numbers give you an entirely different picture of what's going on with this business. Why is it that a year ago we had $1,350 in cash and accounts receivable, and now we have 70. So now you see there's a red flag that goes up. What's going on with this business? We need to dig into this and find out what happened. So anytime you see a big change in a company's balance sheet like that for any of these accounts, it raises questions. And those are the questions that can give a business owner better understanding of a business. And if the numbers have gotten worse, you can look at how to improve those numbers. Or if the numbers have gotten better, you can look at how you can take advantage of that and do more of whatever it is that's leading to that. But you can also take this same information and use it to compare two different companies or three different companies side by side. So if you're looking for a business to invest in, so when you're looking at more than one business side to side, you can start to see the strengths and the weaknesses in those businesses as compared to each other. You can also take the same information and compare it to industry standards, benchmarks, so that you can see if your business is operating as efficiently, as profitably, as another business in the same industry about the same size as yours. But that is the power of having good financial statements. The whole reason that we do all of those nitty-gritty accounting things is to get these financial statements. And then we use these financial statements to actually run the business and understand what's going on. And then we can use that information to help us run a better business. So my hope with this video and with the other financial statement videos is that you can now take these concepts and apply them both to your business, your clients' businesses, or to businesses that you may be interested in investing in, and you'll have this great tool to work with. So until next time, stay balanced, my friends.